Hi, welcome to my channel. My name is Gil Rossi, investor and funds manager. Today I want to show you my valuation of Amazon. It's going to be, I think, quite a long video. There's a lot of things I want to show you about Amazon to understand a little bit better the business. So let's get to it. So here I have my annual review of Amazon. The way I normally make these reviews or these analysis are in two parts: quality on one side and quantity on the other. On the quality side, I study the past performance, management, competitive advantages, and financial position. And then in the quantity side, projections and intrinsic value. So let's get to past performance. First, let's start with the fourth quarter report of 2020, the most recent one that was published 2nd of February 2021. A few things that are of note. Operating cash flow increased 72% to 66 billion. Free cash flow increased 31 billion. And net sales increased 38%. The increases of cash flow and operating cash flow and net sales for a company of almost $1.7 trillion is amazing.
Those numbers are output measures. And I guess you could try to manage your quarterly earnings very precisely, but I think personally that would be a mistake. Most of the work that we put into any particular quarter happened years ago.
The net sales from the annual report, from the presentation, they have been up 38% to $396 billion. If you see, if we go a little bit further back from 2010, you see that this line is it's exponential. They are growing exponentially at a 27% year-on-year compounded annual rate, which is smaller than this one. So they have been accelerating lately. If we see on a per segment, the net sales per segment have also been in all aspects, in all segments, at an exponential growth. And if you see here, the growth rate has been quite healthy. For international, it has been a little bit lower than for North America. And I think this is because North America is the place where they normally first develop all the ideas, and then they spread them to other places. Like, for example, all subscription business and advertising business is mainly occurring in North America. And you can see that AWS, even though it looks like it's decelerating, and in fact it is, but in the last year it hasn't, and I'll show you later why. So another way of checking this is how what's the mix of sales, and you see that the North American segment is growing compared to international, and the AWS is also growing in terms of the weight on the sales of the company. And so this is, I think, explained by what I just said about ad businesses and subscription. Is part of this explanation because they are normally in the US, in the North American segment. And these are big growth and nascent businesses. So if we see again net sales by similarity, you see also these are all exponential. We have here third-party sellers, and this is only services. This is not the gross merchandise volume. This is the gross merchandise volume, and this is only the services that they charge to third-party sellers. This is AWS, and here we have all these small, sort of like smallish businesses compared to these ones. But you'll see if we open the graph on all this, you'll see that this is the way it looks. And look, subscription and advertising are growing quite fast. They are in itself quite substantial contributors of sales. And here we have AWS that we already know. I want to show you here what I told you about the AWS acceleration or deceleration. So you can see here that this AWS growth has been decelerating, and this past year, from Dave Fields, which is the director of investor relations, he mentioned in the call that if you account for this COVID anomaly this year of talking about AWS being virtual and free, AWS year-on-year revenue growth, if you look at it, actually accelerated. So in terms of volume, AWS accelerated. This is in terms of revenue, but because of COVID, they make most of this event free. So this is something interesting. Number 4, which is subscription services, which is mainly Amazon Prime, advertising services. In number 5, which is this other, is mostly advertising services. And this is for me a very important part of the business that is growing, and it's going to grow fast, and it's a high margin business. So let's move to net sales by similarity again, and I want to focus on third-party sellers here. This, as I said, is the service that Amazon provides to these third-party sellers in terms of fulfillment and payment services. So it's the picking, the shipping, and the payment. One important thing here is that Jeff Bezos, in his annual letter of 2018, he provided with this table where he showed what's the percentage of total gross merchandise sold in Amazon that is sold by third parties. The gross merchandise volume that was sold in Amazon was more from third parties than from Amazon themselves. Jeff Bezos mentions that it has gone from 100 million, roughly around here, to 160 billion, around here, in terms of gross merchandise volume. And this is a 52% annual growth rate, which is much higher than the rate of growth that here 25% of Amazon own products. eBay gross merchandise sales in that same period have grown at a compound rate of 20%, from 2.8 billion to 95 billion. So why, he's asking? And well, he thinks that a great importance or great part of that is because of fulfillment by Amazon and Prime membership program. So with the success of these two programs now so well established, it's difficult for most people to fully appreciate today just how radical those two offerings were at the time we launched them. Okay, so now with these figures, what I did was, these are the percentages that Jeff Bezos gave us up in 2018, and this is the only online store sales from Amazon. And so here I can calculate what is the gross merchandise volume or gross merchandise sales from third parties. And I can also calculate the take rate, which is the percentage of the full volume of sales that is services from Amazon. So you can see that this take rate is growing, and this is very, very important to me, at least, because that shows that the service that Amazon is providing to these third sellers is quite compelling. And so that means that every year that passes, third sellers use more services from Amazon. And this is great, because in essence this is growth that Amazon is getting without paying much in terms of inventory, It's a very efficient way of earning money. In essence, it's a higher margin business than online stores. Then well, these are my assumptions. Because it's been growing, I guess it will continue growing at least for these 2 years. $500 billion of sales going through Amazon system, let's say. Another interesting thing, in 2017 annual letter, he shared with us for the first time that the level of, for the last time, the number of Prime members that Amazon has, and it reached 100 million. And I think that we can say here that if we have subscription here, and I think 100% of subscription of most of it is Prime. So in that year, 2017, $10 billion of income was from Prime. Today, I think at 25, they may have roughly 250 million Prime members. And this talks about how much people like it. It's grown, look, 2.5 times in 3 years. And not only the gains of in terms of revenue, but it's so important for the rest of the businesses, and we'll see it there. It's not just an isolated business. It's a whole combination of all the offerings that Amazon gives, and Prime is one of the important sort of like pieces of this whole machinery. Okay, so if we see now net sales by region, you can see here that this is consolidated, and this is North America, or sorry, the United States, and these all here are rest of the world, let's say. You see, an important thing here is that Amazon is mainly a US business for the time being, but I think that all what has been done in the US can be replicated to a certain extent in many parts of the world. So there's lots of growth here. 57% year-on-year growth. And if we go a little bit further in terms of quarterly revenues, you see that they're tending upwards, and yearly, you see here. In these years, there was so much investing that the operating profit was small. But now, even though they are making huge investments, and you will see it in a minute, the operating profit is starting to pick up quite nicely. And here we can see it by segment, and what I want to show you here is one thing. International, for the first time, well, other than here, but this was very small. For the first time, it made a profit. So Jeff Bezos talks about this being a business of volume, and it's easy to understand. Well, it's important to see here that they are only starting to make a profit when they are making substantial profits in North America. So I think that the margins that we see in international are going to be towards the margins that we see in North America. And you can see here that of all the operating income, 59% is AWS. It's really the higher margin of all the businesses that they have, at least the ones that they show. Because I think subscription and advertising are also high margin businesses. Operating margin by segment, where this is what I was telling you before. And this is the 6% is the operating margin of consolidated of the company. And you see it's going up, because when volume goes up, the margin goes up, and then of course advertising, AWS, and subscription services are growing faster than retail and have higher margins. So in the future, I think we'll have a growth in this 6%. But you'll see my projections are quite conservative, and I'm going to keep this at 6%. Okay, so free cash flow, another of the metrics that they use. You see that yearly they're going up 33%, free cash flow, and this is only 20%. This is because they invested like $12 billion, because the acceleration that COVID meant that Amazon had to increase the fulfillment, increase everything, all the infrastructure that they have to sales has to be increased dramatically. COVID has accelerated this trend that we have to online sales dramatically, and the good thing is that Amazon is probably one of the only companies that was fast enough, financially strong enough to adapt to all that. So if we see cash flow statement, what I do is I take 10 years of operating cash flow. I see the growth here, which is just to show you the growth, which is quite healthy, 30% compounded annual growth rate in the past 10 years. The capital expenditures, and as I told you here, look at these capital expenditures, 11, 3 times. And this is because of COVID, what I was talking about. And I like to show capital expenditures in terms of revenue, and not only to show, but as a metric that I'm going to use in projections. And you see that it's in the 4%, 5% level normally in the past 5-6 years, but then suddenly it went up to 10%, double. This is the figure I'm going to use for projections. So here we have free cash flow, and this is the way free cash flow grows. So there is still plenty of opportunity to invest into this business, I think. So that's why I'm going to use a very high level. Okay. So next past performance. That's all past performance I'm going to show. Now I want to talk about management. One thing I want to show you, a quick look at 1997 annual letter, because the 1997 annual letter is where Jeff Bezos sort of like set forth all the conditions of how he thinks about the vision of the company and how he thinks about the way of business of Amazon. And he not only put it in a letter and that's it, he forgot. It's been really the main driver of the culture of Amazon, and in fact every single year he reprints the 1997 annual letter to remind people that this is what Amazon is.
We laid that out in our 1997 annual shareholder letter. We said we were going to take big bets. We said they were going to fail. We said some of them hopefully were going to work. We said we were going to invest for the long term, that we were going to try to take advantage of market opportunities as they arose. And there's a certain kind of investor who is aligned with that approach.
He mentioned that everything is about the long term. You'll see, if you see videos, I'm going to show you a couple of clips from Jeff Bezos. Long-term thinking in Amazon is not only just cheap talk. It's really something that it's ingrained in the culture. Then the other thing that you can really see is the relentless focus on the customer.
The other thing we try to do at Amazon.com is have a customer-centric obsession instead of a competitor-obsessed point of view. And there are, by the way, it's not clear in all companies at all times that this is the right strategy. Competitor focus and, in fact, close following strategies can be very effective in certain business environments, and there's certainly nothing wrong with that. But in our industry, and given the DNA that we have inside the company, the kind of people that we've attracted over time are people who like to invent, people who like to pioneer. So, we have the wrong culture to be close followers. So there's part of this that, we are what we are, and we kind of have to stick with that and make the best of that. I actually think in our space, this is also very handy because the rate of change in the online world is so rapid that close following doesn't work as well as it might in a more stable industry that changes more slowly over time. But one of the things about these fast-changing industries is I often get asked by audiences, if I do a Q&A period, what's going to change in 5 to 10 years? One of the questions that I rarely get asked, and I think is at least as important of a question, and maybe in some ways an even more important question, is what is not going to change over the next 5 to 10 years? And that's another reason why customer-centric strategies can be so powerful because competitor-focused strategies have to change a lot. The competitive set changes so rapidly. Over the last 10 years, our competitive set has changed and the technologies have changed. So many things change. But the basic drivers of our business, the core things that customers want, do not change. We know that what customers want are selection, low prices, and convenience. And I guarantee you that 10 years from now, they're still going to want selection, low prices, and convenience. We are not going to wake up 10 years from now and have customers say, this is all well and good. I love this thing, Amazon.com, but could you make it a little less convenient? It's just not going to happen.
All the investment decisions are going to be based on long-term market leadership considerations rather than short-term Wall Street reactions. Wall Street had to adapt instead of the company adapting to Wall Street.
Warren Buffett has this great quote. He says, you can hold a rock concert, and that's okay. And you can hold a ballet, and that's okay. Just don't hold a rock concert and advertise it as a ballet. Investors come in all shapes and sizes. You have to be super clear about what kind of company you're trying to build, what your approach is.
Well, he talks about failures and successes and failures, and this is so important. You'll see in a minute how important failures are for Amazon. It's a culture where failing is almost encouraged.
One of my jobs as the leader of Amazon is to encourage people to be bold. And if you're going to take bold bets, they're going to be experiments. And if they're experiments, you don't know ahead of time whether they're going to work. Experiments are, by their very nature, prone to failure. But big successes, a few big successes, compensate for dozens and dozens of things that didn't work.
It's part of invention, in essence. He's going to continue to weigh their compensation to stock options rather than cash. It makes the employers owners. And many companies do this, but in the case of Amazon, they do it in a slightly different way because they don't get much in cash. It's a restricted stock. You earn it in many years, not in 1 year. You earn it in over a period of 3 or 5 years. Also related to management, I normally like to go to the proxy statement and see what's the compensation of the board of directors in this case. Board of directors, and you compare with other companies, they are paid quite poorly. And I love this. In the case of Amazon, they pay with stock awards. These stock awards, you see 900 because they get it once every 3 years. So they get roughly 300,000 a year. And the other important, this is much more important, is the executive compensation. And the executive compensation from the proxy statement is highlighted a few things. As a result of our compensation programs encourage experimentation, innovation, and long-term thinking. And we avoid tying compensation to a few discrete short-term performance goals, financial or otherwise. This is, I think, the main difference. If you see the proxy statements of all companies, big companies, if it's Microsoft, Apple, all of those, they have complex ways of calculating how much stock will be paid to this person or that other person, and they put formulas with the best ones use free cash flow and return on investment capital, but very few do this. Mostly they use metrics that are like earnings per share and growth and things like that. None of these people can have an impact on free cash flow directly. What drives free cash flow needs to be the important metric.
Free cash flow and return on invested capital are inputs to a higher stock price. Okay, so let's keep working backwards. What are the inputs to free cash flow? And you keep working backwards until you get to something that's controllable. And a controllable input for free cash flow would be something like lower cost structure. And then you back up from there and you say, okay, well, if we can improve our picking efficiency in our fulfillment centers and reduce defects are very, very costly. It's probably, reducing defects at the root is one of the best ways to lower cost structure. And so then that starts to be a job you would accept.
We recognize that this is a different approach to executive compensation. One important thing is that Bezos doesn't get any salary. Never got a salary from Amazon. Due to Mr. Bezos' substantial stock ownership, he believes he is appropriately incentivized and his interests are appropriately aligned with shareholders' interests, and I completely agree. Mr. Bezos has never received any stock-based compensation from Amazon. Let me show you a couple of things about Amazon in general. Well, the company is very involved in getting zero carbon by 2040. The company is investing in wind and solar projects, and they think that they will achieve 100% renewable energy by 2025, which is 5 years ahead of the target that they have imposed and the target that they were making in this climate pledge. Politicians will not drive, I think, this change, but companies that can do it should do it. And
we have now started putting solar cells on the roofs of all of our fulfillment centers. We're doing 15 this year. These are big fulfillment centers. They're about 1 million square feet each, and so we're covering them with solar cells. That'll cover about 80% of the fulfillment center's energy budget on an annual basis. We are the largest purchaser in the world, the largest corporate purchaser in the world of renewable energy. We've built solar farms and solar wind farms, and so it's, we keep just rolling this out, and we have a goal long term of being completely renewable. So it'll take a long time, but the good news is these are not only great for the environment, they're good business decisions too. The technologies have improved to build a solar farm or a wind farm now. These are competitive technologies with natural gas powered plants and other things. So you can actually do it and feel like you're making a sensible business decision. So I think a lot of companies will do this in the future. I think they should do it. So we're having fun with all of that.
So Jeff Bezos is leaving the CEO position, and he sent an email to all his employees, but a couple of things about that email I just have here highlighted. Amazon is what it is because of invention. This is the thing he said. And right now I see Amazon as its most inventive ever. And why I think this is important, it's because invention is ingrained in the culture of Amazon.
My main job today is I'm kind of I work hard at helping to maintain the culture. A culture of high standards, of operational excellence, of inventiveness, of willingness to fail, willingness to make bold experiments. Many of the traits that make Amazon unusual are now deeply ingrained in the culture. In fact, if I wanted to change them, I couldn't.
He's going to stay as an executive chairman, which means he's not going to relieve his daily sort of like activities from Amazon. He will keep an eye on Amazon. Some things I want to sort of like highlight from other letters. 2019 annual letter, we want to improve workers' lives beyond pay. This is, of course, important to see. Some benefits that Amazon most senior executives receive are given to all employees. Of course, in terms of pay and responsibility, there must be a distinction, but in terms of perks, let's say, to work in Amazon, there are. Amazon has a career choice, which is a prepaid tuition program. So it pays 95% of the tuition. So if you want to study and you want to improve your qualifications, you can do it. In 2018 letter, we wanted to create a culture of builders. Since the beginning of Amazon, that was his goal. People who are curious and explorers. I think that because this curiosity and the way that all this is ingrained in the company, and the way that they treat failure, and the way that they treat long-term oriented thought and all that, there will be another AWS or something. I'm not sure if that's going to be as important as AWS, but something is going to be new that we don't know today in 10 years. 90% of retail remains offline. When he talked about this, was roughly in 2016, somewhere here, 2017, and penetration of e-commerce, 13%, as per my calculations, in the US. The room to growth is quite large.
For Amazon, the consumer business, the three big ideas are low prices, fast delivery, and vast selection.
2017 annual letter, Amazon, for the 8th year in a row, customers ranked it number 1, American Customer Satisfaction Index. There were 560,000 Amazonians, employees, at the end of 2018. And so today we have 1.2 million. So look at this growth. High standards, he says, is one of the big parts of stay ahead of ever rising customer expectations. Bring a new person onto a high standard team and they'll quickly adapt. The opposite is also true. He talks about the 6-page memos. Really, meetings are a waste of time normally. In this case, by doing these 6-page memos, which are made maybe in weeks, and it's made by the whole team making the presentation, has to put together this 6-page memo, and it's sort of like a competition of how can I better do my memo so that the outcome of this meeting is the best possible. So just little things to show you how Amazon works. 2016 annual letter. He is interested in the question of how do you fend off day 2. Remember I told you that for him Amazon has to keep being on day 1. And if you go to day 2, then you're lost. Okay, I'm going to give you a quick compilation of Jeff Bezos talking about Amazon. Probably 5-10 minutes of what I think are some of the best parts of the interviews that I have seen.
So I always tell people who are, who think they want to be entrepreneurs, you need a combination of stubborn relentlessness and flexibility. And you have to know when to be which. And basically you need to be stubborn on your vision, because otherwise it'll be too easy to give up. But you need to be very flexible on the details, because as you go along pursuing your vision, you'll find that some of your preconceptions were wrong, and you're going to need to be able to change those things. We want other companies to look at Amazon and see us as a standard bearer for obsessive focus on the customer, as opposed to obsessive focus on the competitor. Our profitability is not our customer's problem. We had an all-hands meeting, and I said, look, you should wake up worried, terrified every morning, but don't be worried about our competitors, because they're never going to send us any money anyway. Let's be worried about our customers and stay heads down focused. The Amazon Web Services business. Now there's a business that probably
this is the Amazon Cloud stuff?
Yes, and there's a business that's growing, it's in a hyper-growth phase, it's already a significant business. That's a business that probably is not getting as much attention as it deserves.
Is there a dominant player in the cloud business now?
Well, Amazon, in the infrastructure part of it, which is the part that we play in, Amazon is by far the leader.
Right.
That is something that people get confused about sometimes. What is Amazon? We do such a diverse array of things, from producing original content at Amazon Studios to Amazon Web Services, where we sell startups and enterprises, computing infrastructure, to the things that most people know about, which is our consumer offering, where we deliver things in little brown boxes. And these things seem so disparate. How is it that we're doing all of them? And the common thread, and really what it is it's an approach. We have a very distinctive approach that we have been honing and refining and thinking about for 22 years. And it's really just a few principles that we use as we go about these activities. At the very top of the list is one I've already mentioned, but you'll probably hear it 10 times throughout tonight because it's so central, and it is customer obsession. It's customer obsession instead of, for example, competitor obsession, or business model obsession, or product obsession, or technology obsession. There are many ways to center a business. The second one is that we are willing, I would say even eager, to invent and pioneer. So that is, I think that goes along, it marries really well with customer obsession. Customers are always dissatisfied, even when they don't know it, even when they think they're happy, they actually do want a better way, and they just don't know yet what that should be. And that's why I always warn people, customer obsession is not just listening to customers. Customer obsession is also inventing on their behalf, because it's not their job to invent for themselves. And so you need to be an inventor and a pioneer. And the third one that's really central to the way we think about all of our business problems and a bunch of things at Amazon is we're long-term oriented. So I ask everybody to not think in 2 to 3 year time frames, but to think in 5 to 7 year time frames. And so if you start to think that way, it changes how you spend your time, how you plan, where you put your energy, and your ability to look around corners gets better. So many things improve if you can take a long term. By the way, it's not natural for humans, so it's a discipline that you have to build. The kind of get rich slowly schemes are not big sellers on infomercials. It's just as you said. 10 years ago, you wouldn't think that AWS would be such a significant contributor to the business, and there could be more things like that in a kind of 10-year time frame that we don't know about. The one thing I hope will not change, of course, is that approach that I outlined at the beginning. The customer obsession, the willingness to invent, the patience, letting things develop, accepting failure as a path to getting success. By the way, one thing I should point out about failure, and this is a fine point, internally we take it, we know it, and we don't need to talk about it much, but there's a different kind of failure which is not what you want. That's where you have operating history, and you do know what you're doing, and you just screw it up. So that's not a good failure. That's not an experiment. That's just bad operational excellence. And so like if we've opened 130 fulfillment centers, we're on generation 8 of our fulfillment center technology. If we open a new fulfillment center and just woof it, we have to do some internal examination. That's not an experiment. That's just bad execution. And the good thing about these big ideas is they will be stable in time. So I know for a fact that 10 years from now, customers are still going to like low prices. No matter what happens with technology and everything else, no matter what happens, people are going to like faster delivery. It is impossible for me to imagine a scenario where 10 years from now, a customer comes to me and says, Jeff, I love Amazon. I just wish you delivered a little more slowly. This is so inconceivable that you can have great conviction as a leader to continue to put energy into driving speed of delivery. And whatever you're, in AWS, I know that customers, they like low prices, they like availability, they don't want the services to be down, they like data security. It's not very hard to figure out what the big ideas are, and then you can keep putting energy into those things, and you spin up those flywheels, and they'll still be paying you dividends 10 years from now.
So let's talk about them. I have 5 competitive advantages that I think Amazon has. They are not in any order except this one. Network effect, I think, is the most important competitive advantage that they have. Is the most durable one, and it is the one that is hardest for competitors to have. To build this network effect, this network is important. I'm going to go one by one in a minute. Volume that they have gives them a cost advantage. This is another competitive advantage. Brand and proprietary technology, another competitive advantage. Intangible assets. So this is trust. Brand is trust, and trust is not built from one day to another. It's years. And proprietary technology is also so important and so ingrained in Amazon. You can almost say that Amazon is a software company more than a retail company. The ecosystem of Prime and AWS, and also fulfillment by Amazon, provides switching costs. So the moment you get Prime and the moment you get into Amazon Web Services, it's hard to move from them because it's sometimes the cost of switching is so high, and the benefits of switching are so low that you stay within the system, the ecosystem. And this is what Prime and Amazon Web Services have. And by the way, any company that uses subscription and also that uses the cloud once you get into their system, it's hard to move. And then all the capital necessary to build this infrastructure is a barrier to entry. It's so. I mean, I showed you a few things about that, a few numbers, like the level of investment that is necessary to keep this machinery moving is so big, not to mention to develop it. So let's go one, not all of them, but there's only one of all the competitive advantages that I can think, which is efficient scale. This is the only one that it's not present. They have every single one of the competitive advantages that you can hope a business has. Even some businesses with one of these or two are good businesses. They have 5. This is amazing. Okay, let's keep moving. Network effect. I'm going to show you what I think about network, how I see network effect. You have customers and you have selection, low price, and convenience. Let's talk about selection first. The more selection you have, the more customers you attract. The more customers you have, the easier for you to get more selection because you're getting bigger. And also, the more customers you have, the lower you can offer in terms of pricing because you can negotiate volume. And the more customers you have, the more convenience you can offer as well because of that volume you can offer things that companies that don't have that volume cannot offer. I'll show you in a minute. So this is in itself a circle, a virtuous circle that feeds into itself. But then they came up with Prime. And Prime is a subscription service where you pay annually to get video, music, Kindle, gaming, and other benefits like free shipping, which is very important. And then they also have Fulfillment by Amazon, which is a third-party service that where third-party sellers can get that infrastructure that Amazon has and use it to sell themselves. So if you think about it, Fulfillment by Amazon provides selection, and this selection with comes from third-party sellers. So the selection is being fed by Fulfillment by Amazon, which of course feeds this loop. And because of this loop, they can offer fast and free shipping, which also attracts Prime membership. And Prime membership meaning convenience. This fast and free shipping is convenience, and convenience attracts Prime members. So Prime members and Fulfillment by Amazon are connected. Because Fulfillment by Amazon third-party sellers are going to use Amazon infrastructure, and they are going to get to Amazon customers and not any customer. The Prime customer spends 3 or 4 times more than a normal customer. Why? Because they are already paying a fee, and they want to use that fee. They want to make the most of that fee, and because they get free shipping and they get fast shipping. So of course, if you are a Prime member, you're going to use it as much as you can. And third-party sellers will get by getting into this Fulfillment by Amazon system or service, they can get to these Prime members. So this loop also fits into itself. And as I said, because of fast and free shipping, Prime members will grow. So as you can see, this is sort of like an infinite loop of growth. This is virtuous, this is virtuous, and they are connected. About in 2013, in the annual letter, he talks about Fulfillment by Amazon. It's not often you get to delight 2 customer sets with one program. the customers that buy in Amazon and the customers that use fulfillment by Amazon, which are the sellers. So these are the two customer sets, and it's not often that you get to delight two customers with one program. So sellers benefit from one of the most advanced fulfillment networks in the world, easily scaling their businesses to reach millions of customers. And not just any customer, Prime members. Customers benefit from this additional selection. They get even more value out of their Prime membership. So in essence, this is the loop I was talking about. Prime membership and fulfillment by Amazon feed into each other. Okay, so now we add to this loop that I've just talked, advertisers. So this system attracts advertisers that are looking for customers that are looking for products. So it's a great service that Amazon can provide to sellers. And normally, if you're going to advertise in Amazon, for sure, probably you're going to be a seller, a third-party seller as well, because you don't want to advertise in Amazon when someone is looking for something, and then tell them, okay, go out of Amazon and buy it somewhere else. So this is how the loop fits into itself, and this is why I'm calling it amazing virtuous circle instead of Amazon virtuous circle or virtuous loop. And then we have, to all this that we talked about, we have AWS. And AWS...
Amazon Web Services. We had the skills to do AWS. We had probably more distributed computing expertise than anybody else in the world because of the transactions. Transaction systems are so complicated and hard to build, and we had a service-oriented architecture of great complexity, probably before anybody else. And so we could kind of, because we were doing that, we could kind of see the future a little bit, and decided to build AWS, which has turned into a huge business in its own right.
Well, AWS is an infrastructure program similar to what fulfillment by Amazon is done with all the retail part of the business. Is done on the sort of like on the software, on the IT part of the business, because Amazon has to use so much computing power to work on all this, that they had internal systems that are probably the most advanced in the world, that they say, okay, let's offer that to third parties. And this was AWS. So the whole thing here, that all this machinery produces so much data and gives room for improvement on systems and software and all that in a way that nobody else can do. Not even Microsoft, who is a big competitor to AWS, has the ability and the millions of data points that Amazon has. So Amazon, in essence, I think, is seeing what's necessary, and it's offering that through AWS to customers, potential customers and customers that they are already with AWS. So this is another loop I see here, because they are connected. So you can see it's a loop over loop over loop. It's of virtuous loops. It's amazing, really. It's really amazing what has been done. Okay, let's talk about brand and proprietary technology. Amazon is not necessarily a retail company. It's probably more a technological company, software company even. So let's talk about brand. He talks about he says wants to make money when people use our devices, not when people buy our devices. So we think this aligns us better with customers. For example, we don't need our customer to be on an upgrade treadmill. We can be very happy to see people still using 4-year-old Kindles. Let me show you one thing. This is my Kindle. Oh, it doesn't have any battery. But this is, I think, is a 5-year-old Kindle. I still use it, and it works perfectly. Amazon doesn't make that much money on the device. It makes money by you using and experiencing that device. Take a long-term view, and the interest of customers and shareholders align. I want to show you what I think about the structural competitive advantages of Amazon, which are much more important because it's what's ingrained in the business. And they are going to be much more powerful, because no matter what happens in the world, if you have these structural competitive advantages, they will help you navigate anything that happen in the future. This is what I think, at least. And these are the following: customer obsession, long-term thinking, willingness to accept failure, startup day one culture, and wanderer inventor's mentality. All this is ingrained in the Amazon DNA. And there's so many places that Bezos talks about all this and how they interconnect. For example, willingness to accept failure is connected to wanderer inventor's mentality. They go together. And they go together with long-term thinking. You cannot invent if you think short-term. You cannot invent if you don't accept failure. Failure, in essence, is part of invention. Startup day one culture mentality. If you have to be quick, you can't be bureaucratic. You can't live in the past. So all these four are quite connected. And if you see all this, why? Well, because I want to make the customer better. Because they have all this, is that they got all the competitive advantages that I just showed you. So this for me is more important. It's going deeper into the competitive advantages. That's why I call them structural competitive advantages. So this is much more durable advantage to me. And I'm going to show you here the annual letter from Microsoft, just as an amusement. I checked for the word failure, and you can see no matches. But I said, okay, probably if I look for the word invent, and yeah, if you look for invent, you have one result. Oops, it's not invent, it's inventory. Sorry, no result for invent either. Okay, so you see the difference, Microsoft and Amazon. I mean, one being a technology company and has nothing to say about invent, nothing to say about failure. So this is just an amusing thing. So let's go now to financial position. Let's see. Well, the financial position of Amazon is great. If you take from the balance sheet in the past 10 years, cash, debt, short-term, long-term, and long-term leases, the net debt, which is cash subtracted by debt, is 42 billion. And if you compare that with the EBITDA, to me, anything that's below 3 times EBITDA is good. And Amazon has been barely touching 1. And an important thing is the long-term debt. If you see, the payments are very small in the next 5 years, and thereafter, so from 2026 onwards, is where the bulk of it is. And so I'm happy with the financial position. In fact, it's quite a strong position. It could even take more debt, but with the level of free cash flow that they produce, I don't think they need it. Okay, and now finally, let's go to the projections. So the projections, I'm going to show you my model. This is a view of it, where I put the past figures here, and then I try to project these past figures 10 years in the future. And I come with some calculations and some internal rate of returns calculations. So if you see net sales by similarity, this is what we have since they started showing them in 2014. This is the growth in 6 years, 19% for online stores, 41% for physical stores, 38% for third party, 45% subscription, 46% AWS, and advertising, 59%. So you see the level of growth here and here. This is, of course, more settled business. So overall, it has grown 28% per year in the last 6 years. So what I want to project in the next 10 years, I use this, and I'm using 19% as the growth instead of 28% for the next 10 years, which probably is conservative, probably is not, who knows. But I know that at least I'm projecting something that is almost 1/3 of what they have been, 2/3 of what they have been doing in the past. But this is what I'm projecting: 15% growth on online stores from the 19 that they have had, 10%, 18% here from the 38, and then 30 from the 40 or over 50 here. So that gives me 19%. If you add all this, it doesn't give exactly this number, but it's very close, because what I start is with this number, 19. And then one of the things I see here is, if you see, when you use 15% as a metric, you see that this grows really fast, and you don't know whether there's enough room or not. So what I checked was, okay, what's e-commerce, US e-commerce sales? And in 2020, it was $861 billion US e-commerce. And US total retail sales, and this includes only sales that can be sold online. So it doesn't include like sales of items like cars and things like this, or even restaurants. So this is 4 trillion, and it has been growing in the past 10 years at the 4% rate, and this one has been growing at the 17% rate. So what I'm going to do is see, probably in the future they keep growing at the same level. This is what will happen for each of these. And US Amazon estimation, which is this, plus third party, and remember that here in third party we only have the services, so I convert these services into volume, and 2/3 of that number I think is going to be the US, which is roughly what has been now. 2/3 of the sales are in the US and the rest is outside, and because this is data from the US, so this is what I think the result of my projections will be this line here. This is what Amazon will be selling. And if you see penetration of e-commerce, because it's growing much faster than the US retail, it's going to be, it was 20% in 2020, and it's going to increase up to 70%. Is that okay? Well, that means that in the US, 70% of the sales, of all retail sales of things that can be sold online, is going to happen, 71% of that is going to happen online. That looks to me as a reasonable number, but of course nobody knows. And penetration of Amazon is going to be smaller than the one they have here in the e-commerce world, because if you see here, 17% is the growth of e-commerce, and I'm making online stores grow 15% and third party 18%. So the combination of these two means that Amazon is losing share. But this is just to check that my figures of growth here are not dramatically over the moon, let's say. So this I took this information from here, digitalcommerce360.com, that shows how US commerce penetration and the in-store. And so here you can see that retail figures include sales of items not normally purchased online, such as spending in restaurants, bars, automobile dealers, gas stations, and fuel dealers. So this is important, because what we are showing here is everything that can be sold online. Okay, so this is in terms of net sales by similarity. Let's see what happens with AWS, that I am assuming 29% growth. And again, I did some studies of how big the market is and how big the market could be. And AWS sold 45 billion, as we saw. The cloud, which is the infrastructure as a service and the platform as a service, which are where Amazon is competing, was 130 billion by this statista, this company. Calculated that Amazon leads the 130 billion cloud market. Cloud is 130. Global IT spend is 3.6 trillion. So we can see here, all the IT spending in 2020 was 3.7 trillion. In 2021, they expect it to be this. And in 2022, they expect it to be this. And they expect it to grow at a 4.6%. So what I did was I expect this to grow at 4%, the 3.6, and this is what's going to happen. The cloud is going to grow from 4% penetration to 32% penetration. So penetration of AWS will go down from 30 to 32. To me, there's nothing that jumps my eyes and say, oh no, this is impossible that we can have AWS grow at 29%. It is, let's say, within the realm of what's going to happen within the industry. Subscription and other, I think, are similar to AWS, but I haven't made any detailed calculation there. So now let's see the calculations in the model. I take income statement figures, balance sheet figures, and free cash flow figures for the past 10 years, and this is what I try to project later. So revenue, I showed you why I'm projecting it's a 19% growth, which is 70% of what they have been growing. Operating income is going to grow at a 20%. Operating margin is 6%. As I told you, it's not going to grow. And that gives me this EBITDA. This is the way that they have been issuing stock, 1.1% per year. So I will keep this also the same level. In terms of balance sheet, I showed you. I'm going to assume that they keep a one times net debt to EBITDA, which is higher than what they have been in the past. So based on EBITDA and EBIT, operating margin and EBITDA, I use, in this case, I'm not using EBIT. I'm only using EBITDA. I'm using 20 times EBITDA as the value of enterprise value of the company. So if this is going to be the EBITDA I'm projecting, I multiply that by 20. This is going to be the enterprise value. So if you see today, they are at an enterprise value of 1.7 billion roughly. If I apply 20, they should be on a 1.2 billion. So what we're doing with when we buy Amazon at 1.7 is we are sort of like buying growth. The enterprise value, I take out the debt, I divide this market cap by number of shares that I am assuming they will have, and this gives me the price on a EBITDA basis. I do the same with the cash flow. Operating cash flow, I project it at 70% of the growth rate that they had, so it's going to be at 20%. And as I told you in a presentation before, the capital expenditures to revenue, I'm going to keep it at the same level as this past last year, which is double what they have been in the past, but this is conservative. From this, I compute the free cash flow. And if you see the free cash flow as computed by these measures, will grow at a 23%, which is smaller than what it has been growing. Well, the question whether it can sustain this growth of cash flow, that's why I'm saying this is a mathematical exercise. But I think it makes sense to me. I mean, it has been growing in the past 10 years at these levels, quite high. So I think given the market opportunity that they have ahead, the way that they are investing, I think that it's possible. So I do the same. I compute the market capitalization based on this free cash flow and using a 26 times free cash flow factor. If you see, 26 is much smaller than what they have been trading. 26 is what I think is going to, what I want to compute as 10 years from now. Based on all that, here on top I get the free cash flow price and the EBITDA price and the average. And this is what, given all these assumptions, will be the price of Amazon in 10 years' time, $12,000. So with that number, I come to this internal rate of return calculation, which is of 13.7%. So if I pay $3,000 today and I have $12,000 in the 10 years, that's a 13% return plus the 2.4 I receive in free cash flow, which they're not going to pay it for me, but it's going to build up cash or other investments or whatever into Amazon's business. So you have to consider that. It gives me a return of 16%. So even if I pay $3,000 today, I'm getting a 16% return, which is amazingly high. What I do is a sensitivity analysis, and I say, okay, I am able to pay even up to 140% of today's price, which is $4,400, and I will be still getting an 11% of IRR. To me, I would invest in Amazon anywhere above 11%. So this to me would be the fair value of Amazon, 4,400. We know that if the price is below 4.4, my returns are quite good. So this is my valuation of Amazon. Sorry it's taking so long. Probably it's a 45 minute video. I don't know. So probably in the next video I'm going to show you some things that I left out especially from Jeff Bezos talking about Amazon. As you can see, it's a company that I love. I love not only the price, I love the way they do business, I love the future, I love the opportunity they have, and I love the company as a customer as well, which is important. I hope that gives you an idea. If you have been patient enough to listen to the whole video, I hope you have a better understanding of at least a few things about Amazon. And I hope you like it. There's a few new subscribers that are coming to the video. I have 2, so they are growing fast, 2 per week. Thanks very much to those new subscribers. And well, if you like the video, please give it a like. I'm going to upload the video at least once a week. So the next week I will try to do something shorter. Keep in contact. I'll see you later. Thanks very much for watching. Bye bye.